Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing, also on top of Amazon, Intel Corporation, a company that I absolutely love, and this is I think my third video that I've done on them because I just love them so much. This is exactly what I like to see in a company specifically. Now this actually falls in line with, of course, the fact that their earnings are coming out also after hours on Thursday. So let's see if my previous assumptions and target share prices match up with what they got going today. So with that said, let's get started with this analysis. Unlike Amazon, Intel does pay a dividend, a pretty good one too, at 3.21%, which comes out to be 37 cents a share for an annual payout of $1.46. Payout ratio is around 25.41%. We're going to take a look at another payout ratio in regards to the free cash flow in just 1 second, but looking at this, it's not that bad. 5-year growth rate is 6.24%, which is okay, I guess you could say. You know, I personally would like a little bit higher, but nonetheless, Intel, guys, is a major corporation, right? And even though this is a little bit low, what isn't low is this: the dividend growth of 19 consecutive years. They have been paying out the dividend and increasing this dividend for 19 consecutive years. At 25, they actually become something called a dividend aristocrat. Ex-dividend date, guys, is actually coming up on the 5th of May. Payout date is on June 1st, and they pay their dividends quarterly. Now coming over to the calculator, we got the ticker symbol of INTC, market cap of $185 billion. PE, guys, look at this, 9.31. 9.31. Oh my god, this is pretty much just telling me that at $45.22 currently, as if I'm recording this video as of April 27th, yeah, this is looking like a very decent buy. And we're going to check out the fundamentals, and we're going to see. If you guys have seen the previous analysis, you guys know what this calculator usually puts out as what this company should actually be worth. So let's see if it still matches up with that. Now, at the current annual dividends per share, this ends up being $6 billion that they pay out in dividends every single year, which in regards to their 5-year average free cash flow, after this is paid, after this $6 billion is paid, guys, they're still left with $8.5 billion. This comes out to be a payout ratio of 41.2%, which is just insane, right? They have such a huge free cash flow after the dividend is paid, that not only are they still able to pay their current dividend, they can still increase it by a little bit more every single time that they can, because, well, they have a ton of free cash flow left. Looking now at their fundamentals, we got net income of 5 years ago, $9.6 billion, to 1 year ago of 19.8 or 19.9. Let's just sum it up to $20 billion, which is an increase of 107%. Now, what is interesting here is that, yes, it was an increase within the 5-year. However, if you take a look at this within the 4, 3, 2 years ago and 1 year ago, this actually is going down, which is actually fairly surprising. So when we get next year's numbers, if next year's numbers do not come up higher, this actually may start putting in like a downtrend line, which is surprising, and their increase might actually either go down a couple notches or it may even go in the red. Now looking at the free cash flow, the lifeblood of the company, cash from operations less your capital expenditures. Guys, 5 years ago of $10.3 billion to 1 year ago of $9.7 billion. This is actually fairly surprising. This is a decrease of 6%. However, even with this decrease, they still have around $14.4 billion in average for your free cash flow. Okay, so clearly this is not looking too good. From the 5, 4, 3, and 2 years ago, it's perfect, it is beautiful, it's exactly what you want to see. Nice and steady increase. Boom, and then it crashed 1 year ago. So let's see exactly why this happened. Well, as I said, cash flow is the cash from operations less your capital expenditures. So we got the cash from operations of 22, 29, 33, 35, and then 29.9. Very interesting. So from the 2020 to 2021, they did go down by around $5 billion when it comes to the cash from operations. However, when it comes to the capital expenditures, it was 11, 15, 16, 14, so they actually went down from 19 to 2020, and in 2021 they increased their capital expenditures all the way up to $20 billion. Now, even though this is a big increase, guys, right, from 14 to 20, that's a $16 billion difference. Capital expenditures is essentially, if you guys saw my Amazon video, Amazon pretty much had the same situation. Capital expenditures, it is the company reinvesting in themselves. And recently, Intel actually put out a statement saying Intel reveals plan for massive new Ohio factory fighting the chip shortage stateside. So they are actually planning on building a brand new chip factory right there in Ohio, which is pretty close to where I live. And yeah, that probably explains why this capital expenditures is actually this high, even though the plant hasn't even been started building yet. So we're going to probably see this go up. However, it is for good reasons. They are definitely expanding and they're bringing their manufacturing to the United States, which is really, really good. So all in all, even though, yes, the free cash flow is decreasing by 6%, this to me is not a big deal. Honestly, I see this as like a good thing because they're reinvesting in themselves. I mean, building a brand new plant, that's amazing. Coming now to the revenue 5 years ago of $63 billion to 1 year ago of $79 billion. That's an increase of almost 26%. And well, this is exactly also what you really want to see when it comes to the revenue, right? Nice, slow, steady increase from 63 to 71 to 72 to 78 to 79. It's exactly what you want to see. All of these metrics look amazing when it comes to their profits. Now looking at the total assets minus the total liabilities, we're going to be using, guys, total assets and total liabilities, not total current assets and total current liabilities, just because I want to give a much more longer time frame for everything. So if they were to liquidate all of their assets, would they be able to cover their liabilities for starters? And two, how much money would they have left? Well, currently they have $95.4 billion if they were to do this, which is really good, right? Almost $100 billion in assets, which is amazing. And not only that, they have been positive when it comes to their assets and liabilities throughout the whole entire 5 years. Average total assets around $146.3 billion. Average total liabilities is $64 billion. Average assets minus the average liabilities, we get around $82.2 billion. Now, coming over here to the shares outstanding, this tells you whether or not the company is diluting you as the investor. The more shares that a company issues, the less ownership you have. The more share a company buys back, two things happen. Two good things happen here. One, you as the investor get a way bigger piece of the pie. And number two is that if a company pays out a dividend, this is money that they no longer have to pay out, meaning that their payout ratio in regards to the free cash flow actually comes down, which is really, really good. And as it stands, Intel has been buying back a ton of shares. However, something I see here that's very surprising, I don't think I saw this last time, but nonetheless, 5 years ago of 4.7 billion shares to today of 4.1 billion shares. This is a decrease of around 13.16%. However, from the previous year to the current year, so we got 2 years ago to 1 year ago, they increased it by about 1/5%. This is actually very surprising. Even though this is an increase from the previous year to the current year, in the past 5 years, it's still a massive decrease. And lastly, we got the cash equivalents, and currently they have almost $5 billion in cash equivalents with an average cash of around $4.4 billion. Now let's make some assumptions. Low, median, high, as always. 3 different factors: growth, share buyback, and required rate of return. Guys, for the growth, I like to use Seeking Alpha's growth tab. Revenue growth year over year, revenue growth forward, making a conservative assumption between those two. Predicted share buyback, I like to use the shares outstanding graph that we just saw, and the required rate of return, keep it flat, at least for me, 10% to pass the S&P 500 on the best years. Now, for my lowest assumption, let's say a growth of 0.25%, okay? Predicted share buyback of 4%. This actually comes out to be, guys, a target share price of $52.10. For my median assumption, let's say I have revenue growth of 1%, predicted share buyback of 6%. This comes out to be $54.61. And lastly, for my highest assumption, I'm going to say a growth of 2%, predicted share buyback of 8%. This is $57.76. Now let's adjust for debt. The way we do this is we take the cash equivalents and we add the net debt. And then we add that to the market cap that the calculator comes up with. So in doing that, if the number comes down, this means that they have more debt than cash. If the number comes up, they have more cash than debt. As you can see right here, it comes down slightly by around $1 or so to $51.27 for my low assumption. For my median assumption, $53.77, and for my high assumption, almost $57 at $56.90. Now let's add a margin of safety, 5, 10, and 15%. That way we don't overpay for something. So for my lowest assumption, I personally would like to buy between $43.58 all the way up to $48.71. For my median assumption, I would like to buy at around $45.70 to $51.08. And for my highest assumption, $48.36 to $54.05. Guys, the current share price is 45. This company is a great staple to all those people who hype growth, right? This company was all over the 2000 that it was just going to be the next best thing. Oh my god, it was amazing. And then after the dot-com bubble, 22 years later, they have not been able to reach their high point. In fact, for all of those of you who probably do not believe me, here is the graph, the entirety of Intel. So you can see right here, in the year 2000, when the dot-com bubble was at its peak, Intel was at around $75 or so. And after it crashed, 22 years later, they have still never been able to reach that. So Intel's a great example as to how you can overpay for growth, right? Could you imagine buying this at 75 and people saying, oh, Intel's gonna go to 80, Intel's gonna go to 100, Intel's gonna go blah, 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 all this stuff. And then it pops, and 22 years later, you are still in the red. You are still in the red from the initial investment at the high peak of $75. So it's just an example. There are other ones like Cisco that pretty much have the exact same situation. So when it comes to growth, guys, you don't want to overpay. I understand that there's a lot of people that are saying, oh my god, like Tesla or Peloton or whatever, or Enphase, right? You don't want to overpay for growth because that can happen. That will happen, actually. Most likely it will happen. And Intel right here is an example. Now, as it stands, this is a great company to buy pretty much all over here, right? $45.22, that's amazing. Now, in my previous videos, I think I had them at 75. Maybe my growths were a little bit higher or so. I don't really remember, but that's not really the point. The point is that it is still a very, very good price to buy, even with these assumptions being different from my other videos as well. So as it stands, I'm a personal buyer of Intel. I have Intel. I would love to own more of it because of the fact that their fundamentals are amazing and they have a lot of growth potential in the future, and this stock price does not represent this. So as it stands, I love this company and I'm currently buying this company. Does this mean that you should buy it? Absolutely not. Does this mean that you should follow my assumptions? Absolutely not. This is not financial advice. I am just showing you guys the raw numbers that is available for everybody to have and my assumptions. If you do not believe my assumptions, then I highly suggest you get this calculator. It's available for free. Anybody can have it. Go to my playlists where I have calculators, and you can get this one, the book value one, and the dividend tracking sheet. And I have videos on how to use and set up all of those. So if you're interested, just have it and you guys can make your own assumptions. Because let's just say that, well, you think that Intel isn't going to grow at 2%, Intel's going to grow at 20%, right? And they're going to start buying back shares massively at like 20% too, right? Just something insane. Well, at that point, this is where you would be at, right? Obviously, this is a ridiculous thing. That's not feasibly possible. But yeah, if you were to assume this and you believe that, right, then these would be the target share prices that you would buy it at. So yeah, as it stands though, these are just my assumptions. All I'm asking for in return, guys, is for these 2 free calculators and dividend tracking sheet and videos on how to put all of them together. Is like, subscribe, comment, help me grow my channel. It really is just all I want in this world, right? Just like, subscribe, comment. It's free. 30 seconds of your time. Literally just go down there, hit that red subscribe button, hit that like, and that's about it. 2 free calculators and a dividend tracking sheet. And I also am planning to do something this Friday early in the morning before market open and into the market open as well. So hopefully you guys can watch it. If not, you know, I understand it's working hours, right? It is what it is. But nonetheless, I plan to put out a lot more content and a lot more calculators out as well. Now let's do the dividends at the current share price. Now this company is really, really good when it comes to dividends, right? 19 consecutive years and $1.46 annually. So let's take the average US income at $68,703, bring it to the monthly of $5,725. If you were to put in 1 month's income into this company at the current average US income, how much dividends would this company pay you annually, quarterly, and monthly? Well, if you were to do this, this would buy you 126.61 shares, which would be an annual dividends of $184.85, quarterly dividends of $46.21, and a monthly dividend of $15.40. So it's not over 200. However, guys, with all of these fundamentals, right, and the fact that their share price is very, very low to what it should be, right? At least for my assumptions, this is looking amazing, right? This is absolutely amazing. So, my personal opinion, when it comes to dividend play, this is looking pretty good too. All in all, Intel, a company that I have, full disclosure, I don't have a lot of shares. I would like to grow it more, but I do have a couple shares here and there. And honestly, I'm kind of happy that they fell to $45. Hopefully, after earnings, they fall a little bit more. I would not want them to go up, because as soon as they go up, then it kind of loses its luster, right? But love this company. Great example as to how you can overpay for growth. You don't want to do that. Okay, you don't want to do that, because when this bubble pops, which it will pop, when we go into a recession, when we go into a bear market, you are going to be stuck with companies that you thought were going to go to the moon, and now they're pretty much in the dirt, right? Not saying Intel was in the dirt, however, 22 years later, they have not recovered back at all. So that's just something that I'm trying to help you guys avoid. That pretty much is it for this video. Like if you like, comment, subscribe. It really does help here. As I said, you guys can follow me on my YouTube channel, Odyssey, and Rumble. I also have a Let's Play channel, link in the description below. Currently playing Sonic Unleashed, so if you want to follow me there, you can see that too. With that said, peace out, and be on the lookout for the next stock analysis video. And if you can, on Friday at around 8:30 or so, maybe 9, 8:45, between 8:30 and 9, if you want to come to my channel, I will be doing something very, very special for the first time ever. So, yeah. Be on the lookout for that. With that said, peace out, and I will see you all next time.